Okay, so we're now going to have a look at measures of leverage, and we'll start off by defining what leverage is. So what is leverage? It's the effect of fixed elements in the cost structure. So essentially, if you're looking at your income statement, then how much of your costs are fixed. And there's two types of fixed costs. We can have fixed operating expenses, so things like rent on a factory, the manager's salary, and then we can have fixed financing costs. So we're talking about things like fixed interest. So if we're talking operating expenses, fixed operating expenses, we will refer to that as operating leverage. If we're talking fixed interest, we would refer to that as financial leverage. Why is leverage an issue? Well, if I draw you up an income statement, then you will see how fixed costs can actually affect your bottom line profits. So if we just go to a blank piece of paper, and let's just very quickly draw up an income statement. So we've got our sales, our top line figure, let's imagine they are 100. We then have our variable costs, so our costs that vary directly with our sales, and let's imagine they are 30%. So then we'll knock off our operating fixed costs. So like I said, rent on factory, manager's salary, anything that is fixed, which would get me down to an operating profit or an EBIT, earnings before interest and tax, of 50. We'll now knock off our interest. We would probably also knock off tax, but let's just not worry about that for now. Let's just imagine this then gets us down to our bottom line earnings. Okay, which is 25. Okay, so now let's imagine that it's the following year and there has been a drop in sales, and actually my sales have dropped to 60. So we've had a 40% drop. Well, my variable costs will drop in line with my sales, so 30% of 60, so 18. My fixed costs, well, they're fixed, so I'm still paying 20 regardless of how much I'm selling, and that brings me down to 60 minus 18 minus 20, that brings me down to 22. If I carry on, I then knock off my interest. Again, my interest is fixed. So knock off the 25, and I'm actually now making a loss. So let's just have a look at what's happened to my numbers. My sales dropped by 40%. Let's look at what's happened to my EBIT. That dropped from 50 to 20. If you do the percentage change, so 22 over 50 minus the 1, then that is actually a 56% drop. And it gets even worse once I get down to my bottom line earnings. I've actually gone from a profit-making company to a loss-making company. So I've got a minus 112% drop there. So you can see the issue here. This is why leverage is so risky. A 40% drop in sales leads to a 112% drop in my profits. Now, where we're talking about operating fixed costs, we said we referred to this as operating leverage, and this is what, so let's just write that down, that's operating leverage. And then down here, the percentage change in my bottom line earnings for a change in my EBIT, we would call that my financial leverage. The top bit, the operating leverage, well, that is what we would refer to as business risk. And financial leverage, that is the financial risk that the company faces. And you can see why leverage is a problem. A small change in sales leads to a much bigger change in my profit numbers, in my operating profit and my bottom line net income. So if we go back to our slide now, there we go. Our business risk is defined as the variability in EBIT. So it's the top half of the income statement. And the top half of the income statement is affected by your operating fixed costs, your operating leverage. Whereas financial risk is we're looking at the bottom half of the income statement. We're looking at the variability of our bottom line earnings because of fixed interest costs in our income statement. Now, you might have to calculate the degree of operating leverage or the degree of financial leverage or even the degree of total leverage. So let's have a look how we would do that. So you've got a definition here. The degree of operating leverage is the percentage change in EBIT for a given percentage change in sales. So we're looking at the top half of our income statement. Now, if we take the numbers from our example, we had a percentage change in EBIT of 56% for a given percentage change in sales, where our sales only dropped by 40%. So if you do that, we've got 0.56 divided by 0.4. That gives me an operating leverage of 1.4 times. So the way to interpret that is for a 1% change in sales, your operating profit, your EBIT, will change by 1.4%. Now, if you don't have two income statements and so you can't calculate the percentage change, then another way, you've only got a single income statement, and the way to do it is to start off with the sales minus your variable costs in the numerator. So it's essentially calculating your contribution. So our sales were 100 and our variable costs were 30 in the income statement that I started off with, giving us 70. And then on the bottom, in the denominator, we take again the sales minus the total variable cost of 30 minus our fixed cost, which I believe I had as 20, wasn't it? And so we had 50 there. So if you do 70 over 50, then again, you get the 1.4 times. Oops, try and get that little X in there. So 1.4 times again. So that's another way of calculating that degree of operating leverage. The way I remember this formula is you can see you've got sales minus variable costs on the top, sales minus variable costs on the bottom. The only number that is different between the numerator and the denominator is the denominator includes the fixed operating expenses. And as you can see, therefore, if these fixed costs were 0, then I've got the same on the top, same on the bottom, degree of operating leverage is 1, therefore no operating leverage. If sales drop by 10%, your operating profits would drop by 10%. Okay, we can do exactly the same for, before we do that, let's have a go at an example. So here we go. We've got a firm that has produced 5,000 units last year. Fixed cost was $70,000, the selling price was $75, and the variable unit cost was $50. What was the firm's degree of operating leverage at 5,000 units? So just inputting the numbers into the formula that you saw on the previous slide. So there you go, degree of operating leverage we defined as your sales less your variable cost divided by sales less variable cost less fixed. The only difference between the top and the bottom are your fixed costs. We're looking at 5,000 units in total, of which each unit I can sell for 75, and it costs me 50 to produce each one of those units in terms of variable costs, so giving me a contribution of 25 there, multiplied by the 5,000 units to get my total contribution, and then I divide by the 5,000 multiplied by the 25 contribution, again minus the fixed cost, and we get a degree of operating leverage of 2.27. So that's fairly leveraged. For a 1% change in sales, our EBIT is going to change by 2.27 times that, so by 2.27%. Okay, we can do exactly the same now for degree of financial leverage, but now we are looking at the bottom half of that income statement. So it's the percentage change in my bottom line earnings per share for a given percentage change in EBIT. So I'm looking at this bit between operating profit down to bottom line net income. So using the numbers, we had our percentage change in EPS. That was a big one, wasn't it? 112% we had for an only 56% change in EBIT. So if we quickly do that on our calculator, 112 divided by 56, we get 2 times. That's all well and good if I've got 2 income statements and I've got the percentage change. What if I don't? I've only got 1 year's income statement. Then the formula becomes just take your operating profit, divide again by your operating profit. And again, the only difference between the numerator and the denominator is the fixed element, so the fixed interest. So what was our EBIT originally? It was 50. So we've got 50 here. 50 here minus our interest, which was 25. So 25, there you go. 50 over 25 is 2 times. Again, we're getting the same number. All right, again, if we had no fixed interest, then the interest would be 0. My degree of financial leverage would be 1, and therefore the percentage change in earnings would be the same as the percentage change in my EBIT, my operating profit. Okay, let's have a go at another example. So a firm has EBIT of $55,000 and an interest expense of $20,000. If EBIT increases by 3%, what will be the effect on earnings per share, so on my bottom line earnings? So first of all, we need to calculate what our degree of financial leverage is. So take EBIT, 55,000, divided by EBIT minus the interest, so 55 minus 20, I get 1.57 times. So for a 1% change in EBIT, my earnings per share changes by 1.57%. So therefore, if EBIT is changing by 3%, then my EPS will change by 3% multiplied by the 1.57. So a total change in EPS of 4.71%. Okay, so I don't think the maths here is tricky. I think these should be relatively straightforward questions if you come across them in the exam. Like I told you, corporate finance, good news area. Okay, so next we might get asked to calculate the degree of total leverage, where if I'm being asked about the total leverage, then I'm now looking at the whole income statement. And I'm looking at the percentage change in my bottom line earnings for a given percentage change in my top line sales. So we're taking into account both operating leverage there, operating fixed costs, and also our fixed financing costs, financial leverage. So using the numbers from our example, then the bottom line percentage change in my EPS was 112%, wasn't it? And the percentage change in my sales was only 40%. So what does that give us? 112 divided by 40, we get 2.8 times. So if my sales drop by 1%, I can expect a 2.8% drop in my bottom line net income or earnings per share. Now, alternatively, if I know my degree of operating leverage and I know my degree of financial leverage, then I can just multiply the two together to get the degree of total leverage. So our degree of operating leverage was 1.4 times. And our degree of financial leverage was 2, wasn't it? So 1.4 times 2 is indeed 2.8. So that's an alternative method. Thirdly, if I don't have any of that information, but I do have an income statement, again, I can figure it out just by using the numbers on the income statement. So we start off with our sales less our variable costs on the top. Again, put the same numbers on the bottom, sales less variable costs. And then the only difference between the top and the bottom is the fixed cost element. So we've now got fixed operating costs and fixed interest costs. So let's put our numbers from our example on this. So we had sales of 100 less total variable cost of 30, so equals 70. And then we had 100 here minus 30 minus our fixed operating costs, which were 20, minus our fixed interest costs, which were 25. To give us, therefore, 25 on the bottom. So 70 over 25, let's just check, does indeed give us 2.8 times. Okay, so just 3 different ways you can get the same number, the degree of total leverage. So do we have another example? Yes, we do. So let's work through this one together. We have sales last year of 375,000, our total variable costs are 250,000. We're told fixed costs are 70,000 and interest is 20,000, and we need to calculate the degree of total leverage. So using the formula that we saw on the previous slide, our sales less our variable costs on the top, then again our sales less our variable costs on the bottom, then minus the fixed operating costs minus the interest on the bottom. So there you go, just plugging the numbers in, we get 3.57 times. And these are actually the same numbers that we saw in our previous example. So we had the degree of operating leverage of 2.27 times that we calculated earlier. We've got the 1.57 times that we calculated earlier. So actually a nice quick way to do this, as long as I've got those numbers, I multiply the two together and I also get 3.57 Okay, so I think that's absolutely doable in the exam. Right, what else do we have? 3 rules of leverage, okay? I think we should be good with this. So if we've got high fixed costs, that means we've got high operating leverage. If we've got a high debt ratio, that means we've got high financial leverage. If we've got both high fixed costs and a high debt ratio, we have high total leverage. Brilliant. It'll be brilliant if this learning outcome statement gets tested in your exam. Okay, what else might we have to do? Calculate the break-even quantity of sales. So the break-even quantity is the level of sales at which the firm's net income is 0. So it's how many units do I need to sell to generate a contribution that is enough to cover my fixed costs? So how many units do I need to sell to cover my fixed costs? Essentially is what you're answering here. So you've got a formula here. It's your total fixed cost divided by the price less the variable cost, so divided by contribution. So if the price is 85 and your variable costs are 60 and your fixed costs are 500,000, then what is the firm's break-even quantity of sales? Have we done that for you? Yes, we have. There you go. 20,000 units. Now, again, as long as you've got the Texas BA2 Instruments calculator, you can do this on your calculator. So if you have a look, if you pick it up now and just have a look, can you see above the number 6, you've got break even. So to access it, we have to hit second and then the 6. And let's see what comes up. Again, if you've used it before, just make sure you clear it. So second, clear worksheet. And it asks you for fixed costs. So we can put in fixed costs equal to 500,000 and hit enter, arrow down. It's then asking you for your variable costs, which are 60, so hit enter, arrow down. It asks you for price, 85, enter, arrow down. So, sorry, I'm not writing this down, but you've got it all there. There you go, variable costs, 60, price, 85. Remember to hit enter to store it and arrow down. It then asks you for profit. Well, we're calculating break-even quantity, so the profit is 0, so you can leave that at 0, arrow down, and then you get Q is equal to. Well, that's what we're trying to calculate, so just hit compute, and you get quantity is equal to 20,000. All right, so you could use your calculator there if you wish. You might have to calculate net income at various sales levels. Now, I would imagine, having done your financial reporting and analysis, this should hopefully be pretty straightforward. So assuming the following for a firm: price 85, variable cost 60, fixed cost 500,000. We've now got interest of 20,000. I've got 25,000 units. We're ignoring tax in this scenario. What is the firm's net income? So I'm hoping you are all okay with taking 25,000 units multiplied by the price less the variable costs, minus your fixed costs, minus your interest, gets you down to 105,000. Okay, nice calculations in this section. Operating break-even quantity of sales, exactly the same as the break-even quantity that you saw earlier, but we are only looking at our operating fixed costs this time, as opposed to total fixed costs. All right, so it's the same formula, just make sure it's only operating that you take into account. And again, if you wanted to, you can do this on your calculator. And that's it for our measures of leverage. So a nice little reading, I think. I don't think there's anything technically difficult in there. I think the maths is easy. So I think, this should be a good news area. Make sure you're happy with it. If it comes up, it should be easy marks. Okay?